Welcome to anybody that's on the call with us today. Thank you for joining us. I'm Vince Duval with Eagle Homes, and Brad Brewer is the other balding guy in this video. We're here with Amanda Seifert from Landmark Credit Union. She's going to talk about the programs they offer, some of the benefits, perks, what they look like for you. So I'm going to turn it over to Amanda. Thank you for joining us today.
She's not balding.
No, I don't think that's a problem I'm ever going to have. I pay to have a lot of this removed on a regular basis. So, well, thank you guys very much for having me. I'm excited to be here. It is a weird time in the market, and I understand that a lot of people are scared off by what they're hearing in the media, or, maybe they kind of came of age in the past few years when everything was so easy and you didn't have to think, you just did it. It's a different market. We're shifting back into a more traditional market where I think we're driven by economy. Rates are going to go up and down. And it's probably more important now to partner with, real pros that can guide you through, like, you guys who can help make sure that they're getting the right house, because that's weird too. But at Landmark, I think we approach lending a little bit differently. And I know myself personally, I am really big on client education and making sure we really got you in the mortgage that makes the most sense. We were just talking right before this call started that we have a client that, we met a little bit ago. She probably could buy a house today, but she's got two little tiny tweaks on her credit that are going to make a giant difference in what kind of program she can qualify for. And we all agreed, yeah, let's wait. It makes total sense for her to wait until she can get the best possible mortgage for her situation. And I think that's really important. You don't get that with every lender. Some of them just want to get the deal done. But we do want to get deals done, obviously. People want to buy houses. So I think Landmark's really well positioned. We've got a lot of different product options available. So obviously, we do the standard stuff, the conventional 30-year fixed. I think that's kind of what we got known for a long time ago, because that was, our bread and butter. We do it well. Don't get me wrong. We have a pretty easy process. We can do all of the standard stuff that you see, anywhere else. One thing that I think really makes us stand out when you are looking at more traditional products is our first-time buyer program. So for someone who has not owned a home in the past 3 years, or is truly first time starting out, never done it before, we give $1,000 off of closing costs for anyone who is doing a traditional fixed rate mortgage with us. Some people say, well, that's not a ton of money, but it is when you look at how much goes into closing costs and how much some of these buyers are trying to scrape up money to get through the process. Our standard closing costs on a purchase, and keep in mind, this is standard, every situation is different, but we're about $2,000. So for a first-time buyer, we're basically paying half of your closing costs for you. I think especially when you have a buyer who's maybe trying to reach a little higher in purchase price right now because the market got tougher, it makes it a little bit easier for them to come up with some of that cash. Maybe they can push that purchase price just a little bit higher and win out. One of the things I really like about how we approach lending too is that we don't add a lot of overlays. So a lot of lenders, they'll say, okay, we offer this product, but we have all these extra rules that we put on top of it. We don't do that. If Fannie Mae, one of the big mortgage gods of the world, says you can do this, we can do it. We don't add a lot of extra rules. So we really try to make it common sense. We want to make sure we're putting you in a mortgage you can qualify for, but we don't want to burden you with a ton of extra rules. And I think that makes it easier, especially if you do have maybe something unique in your situation, or there's something a little unique about the property you want to buy. Makes it a lot easier to still not have to go into kind of funkier mortgages and still get that more traditional 30-year fix that you want. So speaking of 30-year fixed rate loans, obviously everybody's heard that rates have gone up quite a bit in the past, few months. And I think it scared a lot of people out of the market, or it's, making them really hesitant to move forward. So the good news is, if you look at the past 40 years, we're actually kind of right back to the average over the past 40 years. So we've been spoiled the past 10 years because the government was helping to kind of control those mortgage rates. That wasn't normal. It was never normal. It was never intended to continue. And we're now back to a more normal cycle where it's going to be market driven. So it may be new for some buyers. They may never have seen rates in the 6%. But the good news is that last week, some data came out on inflation that made the bond market fall. That is a good thing for rates. Mortgage rates are tied. It's not a perfect science, but if you look at the 10-year treasury, that's a good correlation. So the 10-year treasury came down last week, which meant mortgage rates took a pretty good tumble. Depending on where you're looking, some are down as far as a full point. So for people who heard a 7% interest rate and freaked out and left the market, because I get it, if you'd only known threes in your whole life, a 7 would be scary. We are firmly back into the 6s. And the really good news is, depending on some of the further economic news to come out yet this year, but some experts are saying they think we're going to hit a little bit of a lull and that we should actually be able to stay in this range or maybe even a little bit better for at least the next few months. So for people who maybe did get priced out the past few months or just got burned out, now might be a really good time to jump back in. You know, reconnect with your realtor, start your search back up, call Vince and say, okay, turn my portal back on. You know, I want to find something before rates go back up. So yeah, happy Christmas. You can finally get your house and maybe we can have you in on time to have Christmas in your new house. And your gift will be that rates fell a point. So that's kind of our traditional stuff, you know, just to get it out of the way. Of course we do traditional. But I think a lot of people think that credit unions, and especially Landmark, because we were just known for the traditional, but that's all we do. It's absolutely not true. We offer a full suite of government lending products. What that means is FHA, VA, USDA. So those products, if you're not familiar with them, VA is pretty easy. Everybody knows that's a loan for veterans or active duty military families. It is a great product. If you served, even if you served 20 or 30 years ago and you never bothered to use your VA, or maybe you used it back in the 80s, but now you want to buy a different house, in most circumstances, you can use your VA loan again. So maybe, you know, 2 houses ago, it didn't make sense for you, but it might make sense now. So Vince just had a good question, down payment and PMI for a conventional loan. So conventional loans for a first-time buyer, if one of the people on your loan is a first-time buyer, meaning they have not owned a home in the past 3 years, we can do as little as 3% down. Any other traditional single-family home or condo, you are looking at 5% down. Now, obviously, the more you put down, the cleaner the loan gets. It can impact your rate, it can impact some of your terms. And if you have less than 20% down on a conventional vanilla loan, you're going to have PMI or private mortgage insurance. So PMI, if you're not familiar, it's an extra premium you pay each month that insures the loan. So in case you default on the loan, it makes the lender whole. That's why we can give you a loan with a small down payment. It's still prudent lending. We can still do it without having to be punitive in cost because we have that insurance for you. But it is an added expense every month. So certainly if we can get you to that 20%, you know, it's a nice thing to not have that PMI. The cool thing about conventional loans is when you build up that 20% equity, so whether the value has gone up, you've paid your balance down, there is the potential to have that PMI removed. So if you buy a house and you start making your payments, eventually that PMI can fall off and your payment will go down. So flipping back to VA, one of the big perks there, 100% financing, no down payment required, no monthly PMI. So that premium we just talked about, the VA waives that for you. There are some other fees that can go into it. If you have a VA disability rating, 10% or more, some of those fees get waived as well. VA can be kind of specific to your actual situation, but in general, it is a 30-year fixed rate. So it's a solid, safe loan, no down payment required, which is great right now. Maybe you had enough for 5%, but then the price of the house went up. Well, you don't technically need a down payment on VA. So that's where we're seeing, I'm doing a lot of VA loans for people who are on their second, third, fourth house. They want to buy the next house before they sell the other one. VA is great because if your down payment money is still tied up in the other house, we can do the 100% financing, get you in the door, and then you can sell that other house. So it's not a big deal that your down payment is tied up. FHA and USDA, these are programs that are really important for the rest of the population, for those of us that don't have a veteran on our loan. So FHA is another government loan program. The money doesn't come from the government, but they act as the private mortgage insurance company. So instead of PMI coming from a private company with all of their rules, It's coming from the federal government, the Federal Housing Authority. The reason that's a good thing, the FHA's purpose is to promote homeownership. They want people to become homeowners. It makes for better communities, more stable families. They want that for people who can handle it. So the FHA is 3.5% down. And then that PMI is standard straight across the board. That can matter because if you happen to have a lower credit score and a lower down payment, on a conventional loan, your PMI might be ridiculously expensive to the point where it might even make the loan just not even cost effective. But on FHA, it's the same. It's an 85 basis points, which it's fancy number that means it's going to be about midway in what you would see in a conventional range. So again, it makes that a little bit more affordable. FHA is also a lot more flexible on credit. So on a conventional loan, they're going to be fairly strict about credit, histories of bankruptcies, foreclosures, things like that. For several years, they're going to take you out of the running. FHA is a lot more lenient. 2 years out of a bankruptcy, 3 years out of a foreclosure, you're eligible for an FHA again. There are some exceptions to that if the event happened because of a circumstance completely beyond your control. Cancer diagnosis, your spouse died, something like that. It's not going to be, well, I lost my job. They don't quite count that, but really, really more flexible. So maybe you did run into some trouble a few years ago. They're going to let you back in. They take lower credit scores too. The FHA program technically starts at a 500 with a bigger down payment. We don't do a lot of those, to be completely honest. They're still not very cost effective. For our program, we generally look at a 580 or higher credit score for FHA. For comparison, a conventional loan wants a 620. But I'm going to be honest, if you have a 620 to a 660, something in that lower range, the pricing is still kind of ugly on a conventional loan. So you may steer towards FHA anyway. Good question, Vince, about bankruptcy, those timing. It is from your discharge date, not from the date that you file. So if you filed for bankruptcy a year ago, but it didn't actually discharge until 8 months later, you are only 4 months out. So, and that is pretty much industry-wide for any program. It is going to count from that discharge date. The exception to that is if you are in a Chapter 13 where you reorganize your debt and pay it off. There are some circumstances where you can do a mortgage in your 13 while you're in that repayment period. You would need to talk to your lender specifically about that because there's different rules based on what you're trying to do. And we do need the trustee's permission to do anything. But we have seen lots of people use a Chapter 13 to maybe refinance to get out of, or I'm sorry, use FHA to get out of their Chapter 13. They pay it off with an FHA loan, or even be able to purchase a home. If it makes sense and makes sense in your finances, the trustee might sign off and let you do it. So that's kind of FHA, big thing there. More flexible on credit, smaller down payment. We're doing as little as 3.5% down. Really cool thing with FHA, that is on a duplex as well. So I know Vince likes to use the term house hacking, which is a great way to look at getting into a home. Costs have gone up. It's more expensive to buy a house. Maybe you feel like you've been priced out till you think about having somebody else pay $1,000 a month of your mortgage payment. Well, then it starts to make more sense. So FHA will do a duplex with as little as 3.5% down. If you're looking on the conventional side, you're looking, depending on how you want to structure it, between 15 and 25%. That's a lot of money. So it can be really cool to do that 3.5% down and get into a duplex, which is a great step into homeownership. Then maybe later on you move to a single family and now you've got your own rental property. So that's kind of the FHA. The other product that is really useful, especially for us kind of out in the Racine-Walworth County area, is USDA. So no, it's not about your steaks or your vegetables. I know it's the same people, but the Guaranteed Rural Housing Loan is designed to promote homeownership in rural communities. It does not finance farms. If you're looking to buy a working farm, that is not what this product is for. It is for people who want to live in a rural community. It is targeted for low to moderate income households. Ballpark in our area, you're going to be around $98,000 for a family of 4. So if your annual income is under that, there's a chance that USDA is going to work for you. It is also 100% financing, the same credit flexibilities as FHA. So you're going to start at like a 600 to a 580 to a 600 credit score. Obviously, the higher you get, the easier it is to approve. So sometimes we may work to get you more to that 620 range, but we can do them on the lower score. No down payment required. On USDA, that private mortgage insurance is even lower. The USDA subsidizes it a little bit more than FHA does. So it's actually about less than half of what even FHA charges. And FHA is cheap to begin with. So it's a really flexible product. It does have that income cap. So you can't have somebody making 200 grand a year doing it. And it is limited in location. You do need to be in a rural community, which generally means a place with under 10,000 people in it. So City of Burlington wouldn't work, but you can do pretty much anywhere in that circle around it. So Lyons, Kansasville, all those little areas around it. Waterford, Rochester, west of the I in Racine County, it's pretty much only the city of city of Burlington, city proper, that is out. Town of Burlington is fine. You get into Walworth County, all of Walworth County is eligible. Half of Waukesha County, pretty much if you stay outside of Waukesha and Brookfield and you stay more in the, Eagle, North Prairie, Mukwonago areas. So a lot of areas around here that are going to be completely eligible, any home there is going to work. That can be a great way if you're ready to make the payment, but you just don't have a huge down payment. USDA can be a great way to do that. With all of the government loans, it is important to point out there are some property condition requirements. None of those government loans are going to do a fixer-upper. If you're looking for a rehab project, this is not the loan for you. They are looking for move-in ready homes where the buyer is not going to end up with a ton of financial surprises when the roof fails, things like that. Doesn't have to be perfect. I like to say that ugly is okay, broken is bad. So a Pepto-Bismol pink bathroom that hasn't been upgraded since the 70s, as long as it works, it's fine. But if the toilet's leaking and the shower doesn't work and the furnace only works half the time, no, that's not going to fly. But it doesn't mean you can't buy a house that has some issues. It just means you have to work with the seller. And this is where you need a realtor who really does know what they're doing to help you walk through that, figure out what needs to be fixed before you get too emotionally invested in that house. But a good realtor can help you. Brad's had plenty of times he's called me from a showing and been like, hey, there's this weird thing. Can I send you a picture? And we'll try and guess, is this going to fly or isn't it? And he's pretty good at guessing, what's going to be a problem. That's where experience comes in. So they can help you figure out, is this house going to pass? Is this something we can fix to get it to pass? Or do I need to pass on this house? So they're great products to have out there. A lot of people don't realize still that Landmark does these because it wasn't necessarily something we advertised a ton, but no, Brad, I'm not calling you old. Although, you said it and he did get announced as the balding guy. I'm just saying. So besides, I think technically I've got more experience than you. So I'd really just be calling myself old. So, these government loan products, they are solid, safe ways of getting into the market. If maybe you don't meet that traditional, I don't have a ton to put down, I don't have great credit, but I can do this. I can make my payments. I can be on time. I can support this house. I'm just, not perfect on paper yet. That doesn't mean you shouldn't own a home. It just means we need to get a little more creative in how we get you there. So those are some great options that we have available to be able to help those people who are maybe not the complete mainstream buyer yet. We can get you in the door with a solid loan. You don't have to do anything crazy. You don't have to take something that's going to blow up in your face or that has $10,000 in closing costs. We're not going to do anything like that. Speaking of closing costs, I will say that we are much, much cheaper than any of the big nationals. I like to make fun of Rocket just because, they're ridiculous in how they advertise, but our closing costs on FHA via USDA are pretty much the same as our closing costs. There's a few tweaks, but we're still looking at total closing costs, setting up your escrow account, paying your insurance, all that kind of stuff under $4,000 usually for the average price house that we do. It is not unusual for me to see quotes of $8,000 to $10,000 from those big national companies when somebody talks to them first. So please, please, please do not assume that your local credit union can't do what the big boys are doing. We probably do it and we probably do it better. To be completely honest. Also, good question about the gift funds. Almost all of our mortgage products allow gift funds. That can mean your down payment, your closing costs, maybe you've got enough money for some of it, but not quite all of it. Grandma finds out over Thanksgiving dinner that you want to buy a house, and she says, hey, I would love to give you $5,000 to help you in the door. You know, can we do that? Absolutely. All of the government loans will allow gifted funds. Even all of our conventional loans in almost every situation will allow gifted funds for down payment and closing costs. Now, the gift does need to come from a family member. The definition of family has finally caught up with how the world looks at it. So it used to be it had to be documented marriage, blood relative. They're not quite that picky anymore. So if it's the gentleman that you have called uncle since the day you were born, and but they're not related by blood, that's okay. If you are in a committed, long-term, stable relationship, but you're just not married, that spouse, they don't need to legally be a spouse. Your partner can be a gift fund. It needs to be someone with a clearly documented relationship clearly documented interest in the borrower. That's pretty loose. So what it can't be is the seller. It can't be the realtor. It can't be some random person at a company 3 states away that charged a fee to give you this down payment, and then you're gonna have to give it back. It needs to truly be someone in your life who is giving you that money and does not demand that it be repaid. There is a documentation step for all of this. Please, please, please don't ever just have grandma write you a check or hand you a bunch of cash. Talk to me first. I will guide you through those steps. It is much easier if we document everything as we go, or if I tell you ahead of time, here's exactly what I need. Because if you have to go back to your 85-year-old grandma and say, I need you to go in your online banking and get a copy of that check that I cashed a month ago, grandma's probably not going to do so well with that. I mean, maybe she will. I don't want to say grandma's not tech savvy, but chances are she's going to struggle with that. So it's better if we talk about it ahead of time. And yes, absolutely, no just undocumented money. Everything has to be documented as we go along the way. So that also means if you're looking for a down payment, you can't just take a cash advance on a credit card, and it can't be true cash. In our world, true cash outside of the banking system doesn't exist. So if you're thinking about buying a house a few months from now, deposit that money in a savings account now. Or the other thing I suggest a lot is, hey, if you have cash built up at home, that's okay. Start using cash for your regular expenses. Pay for your gas in cash, your groceries in cash. If you can pay your rent in cash, that one's borderline. Talk to your lender first. We might need to document, we might not. But your regular everyday living expenses, pay that in cash. Let your payroll sit in your bank account. That's all documented money. I can prove where that came from. I don't need to prove how all of a sudden you weren't using your debit card for your groceries. We don't care about that. So there's ways around that. But basically, there's a lot of different ways that you can enter, even if maybe you don't have a ton of cash. All of those loan programs, the standard, FHA, VA, USDA, conventional, you can use your 401k as a down payment source. Now, that gets a little questionable. We usually talk a lot about whether that makes sense or not. For some people, it does not. But for some people, if you're like, hey, look, I am ready to go, I can do this. The only thing I don't have is down payment. But I have a ton of money in my 401k because I've been sucking a ton of money into it and I kind of neglected regular savings. That might make sense. I view it as you're trading one investment for another. If you're taking money out of your 401k and putting it into real estate, you're just changing the type of investment that you have it in. That's how I look at it. But if we're going to decimate your retirement account, maybe that's not the best idea. So that's something I would say, really talk to your lender first, talk to me first about it. We can decide if that makes sense or not. So that's kind of the more general stuff that we do. It's the Govy, the fixed rate. Those are the things that, a lot of lenders have. I'm not going to say they all do them the same. I've been doing this almost 20 years now. So I think maybe I'm a little more thorough than some lenders might be. I know a lot of the ins and outs. I will say I am an FHA VA specialist. Getting people into homes who maybe thought they couldn't is a sweet spot for me. I love doing that. My absolute favorite is putting single moms in homes, ones who have had to, not just single moms, single parents. I love putting single parents in homes, but I also really, really like putting young single women in homes, because that isn't necessarily a demographic that got a whole lot of love over the years, but it's, young single women can own homes. So anyway, that's my soapbox. But so with those programs, they're kind of the more traditional that you would expect most places to have. Landmark also has a portfolio. And this is my absolute favorite, especially right now because the market is a little bit odd. Portfolio lending means we are using our own money. This isn't getting sold. It's not getting put in debt pools. It's not going to the FHA, the VA. It's Landmark's money, which means to some extent, we get to make the rules. Now, we still have all the fair lending rules. We still have all the underwriting rules we have to follow, but some things we get to decide. One of my absolute favorite programs right now is what we call our Gold ARM program. This Gold ARM program goes up to 90%. First of all, this is meant for owner occupied, but also second homes. So vacation homes. This is not investment products though, okay? So owner occupied second homes. It goes up to 90% of your purchase price, no PMI. So like we talked about, most loans you need to have 20% down to avoid that PMI. This one, we're only going to require 10% down and we waive the PMI. It is an ARM program. We offer 3, 5, and 7-year ARMs. In today's market, almost all of what I'm doing is either our 5.5 or our 7.1. What a 5.5 means is that your rate is locked for 5 years before it can begin to adjust. And then it can only adjust once every 5 years thereafter. It's still a pretty stable loan. It can only change once every 5 years. If you look at normal market swings, again, you got to take the past few years out of it because that wasn't normal. But if we look broader history, normal market swings, every couple of years, you'll go up, you'll go down. That's a normal market. So right now we are kind of on a more upswing. We're starting to come down a little bit, but we know realistically, we should come down to a more normal. Experts are saying we should get into the 5s. We may even brush the 4s again. Don't hold your breath for 2s or low 3s. That is probably not coming, barring some other major catastrophe, but I will live without the 2% interest rate if I don't have to wear a mask to go to the grocery store, okay? So those ARM products, they're the 5.5, it's locked for 5 years at a time, and then it can begin to adjust. That one can adjust 2% on the first change date, no more than 2%. It's gonna follow what the real market did. So let's say you start at 5.875 and the market has gone up to 6.25. At the end of the 5 years, you're only going up to that 6.25. It can't go any higher than the actual market has driven. There's a formula that we will show you of exactly how it can change. But the worst it could get would be 2% higher, so 7.875. Then it's locked for another 5 years. At that point, it could go up or down. Rates can adjust down. So if the market happens to be lower when your adjustment comes, your rate can actually move down. It's 2% the first change date, 2% each change date thereafter, to a maximum change of 5%. So if you start at that 5.875, the highest that loan could ever go would be 10.875. Even if the market had gone back to 18%, we go back to the 80s, the worst that rate could ever get is 10.875. But if you think about it, it can only adjust 2% each 5 years. You've got a really long time before it can get to that 10%. At some point in that 10 to 12 year span, I would hope that you would have reached out and said, hey, maybe I need to refinance this. Like, let's lock in before this gets any uglier. Speaking of refinancing, there are no prepayment penalties on any loan offered by Landmark Credit Union. You can refinance out of any of our mortgages at any point. So a lot of people are, they're afraid to take on a house. Like, I don't want to buy a house right now. Rates are really high. But so is rent. So is, if you're saying like, there's a million reasons I should buy, but the rate, we can refinance you out of this in a few years when rates come down. Now, obviously, I can't promise they'll come down. But if you look at all the national averages, if you talk to the experts, they will. At some point, they will cycle back around. So I love that. Vince, I'm totally stealing that. Marry the house, date the rate. I'm going to start using that with my clients. But it's so true. You can buy the house now. Stop, prices on houses keep going up. And even if appreciation chills, it's not going to go backwards. They're still going to keep getting more expensive. And even if you don't buy, your rent will keep going up. I don't see any signs that rents are going to slow down anytime soon. But if you get the mortgage now, at least you're locked in. We start you somewhere you can afford. And then when rates come down, you can refinance it. So that's what I love about these Gold ARMs. It's long enough to be stable initially. You've got the 5.5 that can change every 5 years. Our 7.1 is locked for 7 years and then it can begin to change once a year thereafter. So that one, after the 7 years, it does adjust a little more frequently, but you're locked a longer period of time the first time. For our first time buyers, or people who are maybe on that other end where they're like, this is my last house before I retire and move south. We're seeing a lot of those. Let's be honest. Are you going to be in the house 7 years? Probably not. You know, a lot of first time buyers are like, no, this is a 3 to 5 year plan. And then I'm out, you know, then we're moving to the family house in the suburbs. Or if your plan is to be out 3 years from now, who cares if you're in a 7 year ARM, you know? So I really like those products right now. They are conventional loans. So they are a little tougher than the FHA VA. We require a minimum credit score of 660 for those products. But even that, 660 is still only fair credit. You know, it's not like we're requiring a 740 credit score or anything crazy like that. The other thing is, because it is a portfolio loan, we get to be a little bit more flexible in our underwriting. Again, there are always guidelines that have to be followed. We're not going to do something crazy and risky for the credit union. But if you've got a situation that makes complete sense, but it just doesn't quite fit the mold of a traditional, 30-year fixed slam bam easy loan, let's talk about it. In those portfolio products, we can do some things that make sense and we get it and we know you'll pay us back. A good example of this is conventional guidelines say if you are self-employed, you need to have been self-employed for 2 years. Well, okay, that kind of makes sense. If you've got a brand new business, we want to know how that business is going. But sometimes we see someone who is an insurance agent and they were an insurance agent with a W-2 for the past 15 years. They have an established client book and they just switched from W-2 to 1099 this year. Same business, same client book, nothing has changed except now they're technically self-employed. Well, according to normal conventional rules, I can't touch you because you haven't been self-employed for 2 years. Those are the kinds of things we'd probably look at that. And if everything else in the deal made sense, we've done things like that. So I really love that portfolio because it means we don't have to do everything according to a rule book. It needs to make sense. We're not going to do something crazy. So please don't come to me with a 500 credit score, no down payment, a recent bankruptcy. You need some more time to heal and reestablish credit before a mortgage is, probably a good idea. But if you've got this one weird thing that's knocking you out of conventional guidelines, but it makes sense in every way, talk to us. That is the beauty of portfolio lending. We don't have to write by somebody else's guidebook. We can use our own common sense. I'm not promising we'll do everything, but we've gotten some pretty, impressive stuff done that I know maybe I couldn't have gotten done somewhere else. A credit union's mandate is to give back to its members, and we try to do that through the products we offer as well as our pricing. So I know when I joined a credit union, I said I would never drink the Kool-Aid and I would never be that person. But I have worked in a lot of different lending institutions. I've been a broker, I've worked in big banks, I've worked in small banks. I'm 6 years in at a credit union and it really is different. I'm seeing that difference every day. And one of those things that I think Landmark really does differently is how we address that portfolio and how we price things. We are truly trying to make sure that we can get our members in homes that they can afford, they qualify for, without having to gouge them. We have to cover our costs. We can't start hemorrhaging money, but we genuinely want to see our members succeed and get the things that they want. So it's been a really cool experience kind of being on that other side where I'm not answering to shareholders, I'm answering to the other members. It's a different philosophy. It's a different approach. So Vince, I think you just had one other question. What was that?
It might have been, can you buy down the 5.5 or 7.1 interest rate? I know you can buy down conventional.
No, so that is a good thing. We do not do buy downs on our ARM products. Our ARM products have pretty decent pricing to start with, and buy downs don't work the same way. It has to do with when you're buying down a rate on a conventional, you're kind of subsidizing what we would get paid by Fannie Mae, Freddie Mac, whatever, for doing a loan at a certain rate. When it's our own money and we're not selling that to someone else, it's not quite the same in how we equal out like the cost of the mortgage. So we don't have buy downs available on those right now. There's some talk about perhaps doing that in the future. But as of right now, no, the rate we have on it is the rate. It is important to remember on all products, rate is going to be based on your down payment, your credit score, the property type, and then some other features that are specific to each loan. So our standard pricing is our standard pricing, and we don't offer any buy downs on that right now. Now, that's the Gold ARM program. If you are looking at just a traditional ARM, you don't want that specific gold. You want a 5%, 3-year ARM, or 5% down, 3-year ARM with PMI. Those I do have some flexibility on some of them for some buy downs. But that's something that we generally talk about, case by case as well. Anytime you're looking at a buy down, you want to make sure you're looking at what am I spending to do this buy down? How much am I actually saving each month? And how long will it take me to recoup what I'm paying up front? My rule of thumb is usually 2 to 3 years. If you can't break even in 2 to 3 years, it's probably not worth the buy down. Because most people will change their mortgage every couple of years, whether it's that they've sold the house, refinanced, done something. But now, knowing what we predict the market to do in the next couple of years, I'm even a little tighter on that. And I'm telling most people, if you can't break even in 18 months to 2 years, somewhere in there, probably not worth it. Because if you pay a ton up front to buy down, and it's going to take you 4 years to break even, and you refinance in 2 because rates come down, you've wasted all that money. And with a buy down or discount points or whatever you want to call it, once you pay that at closing, in almost every loan, it's gone. Most of those, you do not get that money back, even if you refinance right away. So it's case by case, loan by loan. We actually do the math and figure out. Sometimes it makes complete sense. There are days where the market is goofy and we look at it and I say, hey, this is weird, but for $200, I can buy you down 1/8 of a point. You'll have that back in 3 months. Do you want to do that? Well, that's a no-brainer. Of course you do that. But I actually do the math every time when we're looking at a buy down. What's that break-even point? What's your plan? Some people tell me, look, I don't pay attention to the market. I get a mortgage when I buy the house, and that's the mortgage I'm going to have 30 years from now when I pay this house off. And I'm dying in this house, so this is how it's going to go. Okay, fine. For you, a buy down might make sense. But somebody who tells me, look, I have 2 years of nursing school left, and then I'm selling this place and becoming a travel nurse, and I'm going, well, then we're not going to do a buy down. It doesn't make any sense. So that is a very specific thing. That is something that you really want to watch when you're looking at online lenders. They put a lot of points and buy downs in. It's why sometimes if you're just looking online, the Rockets of the world do look like they have better pricing than us. Read the fine print. Some of them you're paying $6,000, $7,000, $8,000 in buy down points so that they can show you that really, really great rate. But if you're only saving a couple bucks a month, does it really make any sense? So that's why we really try. I always look at rates as here's our standard closing cost. Then let's play with weird beyond that. Let's start with the normal and then look at the other stuff.
Awesome. Amanda, my other question I put in there, and it's kind of a hot topic when we talk ARMs, and you compare an ARM today to 2008. What's the difference? I mean,
that is a great question. Yeah. So, okay. I'll admit I was a lender back in the Wild West. I was an assistant. I didn't do a whole lot of these myself, but I learned the ARMs back in the Wild West. So we're talking the early 2000s, pre-crash kind of ARMs. They were ugly. They were greedy. They were designed to close loans, and nobody cared about the human being on the other end of that loan. Some of the legitimate things that we're seeing that are different now. A lot of the ARMs back then, first of all, we could qualify you at your ARM rate. So let's say you were doing a 2-year ARM and it was at 3%. But then the terms of the ARM at year, the first change date, we knew that rate could instantly go to 6%. Well, common sense would say we should probably look at that 6% and make sure you can afford it. Because if it's only a couple years out, can you afford the 6%? Well, back then we didn't have to look at it. We could just look at that beginning. Some of them literally had teaser rates that were only 6 months long. And in some cases, you could qualify them at that 6-month teaser rate. It was stupid. You never should have been doing that. Today's ARMs, there are preset rules based on how long your arm is locked for. If it is locked anything 5 years or less, I have to add to your rate and qualify you at a higher inflated rate to make sure that if your rate adjusts up, you can still afford that loan. Doesn't mean you're going to pay that higher amount, but I have to look at the what if and make sure that if the worst case what if happens, that you can still qualify. Now, when we look at those longer term arms, like the 7 years, then I can qualify you at the actual rate. But again, we're looking at averages. You probably won't even be in this loan 7 years from now. So it's fairly stable to say that. The qualifying is one of the bigger differences. One of the other differences is just looking at lending in general from then versus now. Back then, we could be doing an ARM rate that we knew could blow up on you in 3 years. But you could tell me what you earned. You could tell me where your assets were, and I didn't have to check any of that. Oh, you work at Burger King and make 10 grand a month, but you're not a manager? Sure, I believe it. Why not? Well, are we shocked that these things blew up on people? Of course they did. Now we are back to a world where we have to document income. There is actually this whole rule. We call it ATR. It's ability to repay. Everything we do means we have to have a reasonable presumption that you have the ability to repay this loan. Now, like I said, we can have some flexibility. Normal market says 2 years self-employment or you don't have ATR. Well, we can use common sense. But what I can't do is have somebody who tells me, no, trust me. I know my income taxes say I make this, but I really make this. Well, okay, that may be true, but that's between you and Uncle Sam, not you and us. So we need to see on paper in some way that you can actually repay this loan. That is a huge difference when we're talking about somebody who's taking on an ARM where maybe their payment will rise down the line. I need to know that you didn't lie to me about your income and that we have reason to believe you really can make those payments. I don't want your loan blowing up on you 3 years from now if that rate starts to go up, or 5 years or 7 years. So that's one of the other big differences. One of the other things are those caps. We talked about that at each change date. It can only go up or down a certain amount each change date thereafter. The caps back in the Wild West sometimes were ridiculous. There were some programs that did not have caps, or the caps were so high they might as well not have. I remember one particular loan program we offered, the cap was like 13%. I mean, if your rate goes up 13% overnight, forget it. You might as well not even have a cap because you're not going to be able to make that payment. Loans now have to have a cap. Now, I'm not saying there aren't some products out there. There are some that keep trying to test the market and come back out with some of these crazier, we used to call them subprime or Alt-A lending. Some of them are testing the market, and we're seeing a lot of them fall apart just as quickly because the market doesn't have appetite for those. Not only do people not want those loans, but investors, even the actual big banks at the end that fund the whole world, they don't want them. They don't want a repeat of before where everything fell apart. So when you're looking at an ARM product now, especially if you're looking at an ARM product from someone like us or a legitimate FDIC insured bank, an NCUA insured credit union, we are held to very strict guidelines on that. We can't offer those crazy things. The negative amortization loans, the pick-a-pays, where you could say like, well, I know I owe this each month. And when my rate goes up, I'll owe this each month, but I'm actually only going to pay this. And then this difference, well, that's going to get added to my balance. Well, of course, those blew up. When you look, they sounded so great back in the day. Oh, I can get this person in a home that they can't afford and will never be able to pay for and will lose in 2 years. Nobody wants to go through that again. None of us ever. As a lender, I never want to get that phone call again. And I got it. Hey, I can't do this anymore. Where do I mail my keys? I never want to get that call ever again. So, we want to make sure that if we're putting someone in an ARM now, it's a flexibility, it's an alternative. It's not a cheat to get someone into a home that they can't afford. So those ARMs that we're doing now, we're not doing them and saying, hey, look, you really should only be buying a $130,000 house, but let's get you in a $250,000. That's not what we're using these ARM products for. What I'm using them for is, hey, I know you were looking at $250,000, but because of price increases and everything else, we really got to get you to $265,000 so that you can really get that house you wanted. Maybe that might make sense. What we're doing a lot more of, though, is, look, I know you said you'll go as high as $1,500 a month. but you'd really prefer to be at $1,300 a month. So on a fixed rate, you're going to be right at that $1,500. But if we do this ARM, I can get you in at the $1,350, which is more of your comfort zone. That makes more sense. You know, if it's about helping somebody feel more comfortable in their payments, but we're not trying to cheat the system, I think that's where an ARM can have a very valid place. As you get to savvier buyers, you know, maybe not a first timer, somebody who's trying to, you know, just get in the door. Savvier buyers are looking at that and saying, huh, so if I take that $200 a month that I could be spending on a mortgage, but I'm not, and I invest that and I do this, and I, you know, some of them are turning that money to work for them. And that's a very valid place as well. But that's maybe more than a lot of our first-time buyers think through. First-time buyers are more like, how can I do this affordably and comfortably and not go into credit card debt trying to support my lifestyle? That's valid. Savvier buyers on the other end, maybe you are buying your second or third home and you're starting to think, well, you know, if I took that money and I suck it in the market while the market's down and I can buy more stocks and I can see their wheels turning, you know, that's a very valid approach too. Maybe we keep your mortgage more affordable so that you can put that money to work on something else, whether it's investment or paying down debt. Or I'm getting an awful lot of people who are going, you know, I have twin 16-year-olds. Do you know what tuition's going to look like in 2 years for me? Yeah, let's do the ARM. So there's a place for it. And yes, you are right. One of the other awful things, thanks for reminding me, Vince, that the market did back in the day, we'd let you borrow more than your house was worth, knowingly let you borrow more than your house was worth. Sometimes 15, 20, even 25% more than your house was worth. Again, how were any of us surprised when these loans blew up on people? Because when you go through a period of really quick property inflation, like we've had the past few years, you know it won't last forever. Now, this time is different. None of us are expecting that giant crash backwards, partially because we are being a lot more prudent in our lending. The people we're putting in these homes can afford them. We don't expect to see a ton of foreclosures, but vast appreciation like that, it can't keep happening forever. The market can't bear it. So it will slow down. It'll become a more normal number. You know, normal averages over the past 40, 50 years, it's more like 3 to 4% a year. That's an attainable, you know, sustainable number. The 15, 20, 25% we've been seeing in some markets, that's just not realistic. It won't last. It's great when it happens, but it won't last. So if I'm putting you in a home that I already know you're upside down on, and then that market slows, well, of course, I'm setting you up for failure. That's not happening anymore either. We are using real appraisals from real appraisers who are allowed to independently do their job. So if an appraiser comes back to me and says, hey, look, I know they were looking for 225 on this house, but it is 215, and that is the most I can squeak out of it, my loan is based on 215. There's no more saying, oh, come on, I'll buy you whiskey. I can't do that anymore. It's illegal. It never should have happened in the first place, but it's not happening anymore. So it's really just a different market where we are looking at smart. We want creative loans. We want to help people who belong there, who can afford it to be in homes. We're not trying to put people who aren't financially ready, who can't afford the payments, or who are just going to lose it all in 2 years. That doesn't help any of us. It's bad for everyone. So we're moving away from all of those products. And most of them are illegal, and a lot of them are just so frowned on that they just don't exist. And I can tell you at Landmark, that's not our style. We never offered those kinds of loans. That wasn't something that we did here. And it's not something we're ever, well, I mean, if we ever did start doing those again, I'd leave. I'm not going to do that. But I don't see Landmark ever doing it. It's just not our business model. It's not how we look at things.
Awesome. Thank you, Amanda. Yeah. Did we miss any other programs that you guys offer that come to top of mind? I know we covered, you know, some of the main ones, the FHA, USDA, your traditional, and then your Gold ARM programs. Are we missing anything that jumps out?
One kind of cool one we have that not a big deal for everybody, but we do have what we call our doctor program. It should more aptly be called a medical professionals program. This is graduate level medical professionals, doctor of physical therapy, actual MD, OD, dentist, chiropractor, nurse practitioner. This is unfortunately not like a nurse, surgery tech, something like that. It's PhD or doctorate level medical professionals. It's the ones that are coming out with $200,000 to $300,000 worth of student debt. So this is one of our in-house portfolio products. I won't get super in depth, but we look at student debt a little bit differently. We allow for higher debt ratios, and we can do really minimal down payments. That can be really important because if you have been, especially someone who's maybe just finished a residency and now they're out and getting their real income, if you have a ton of student debt, and I don't know if everyone's aware of this, but residents don't make a whole lot while they're going through their intern and residency years. So if you've been carrying ridiculous student debt and you were only making $70,000 a year while you were working 80 hours a week to finish your training, and now you finally got that income, you probably don't also have 20% to put down on that doctor house that you now want to buy. So this is kind of aimed for bridging that gap until that, they're a little bit more established. So it's kind of a cool product. If you've got someone who fits that need, we can certainly talk about that. But it is a little bit different. It's not something you're not going to see us advertise that one a ton lot because it is pretty niche, but it's kind of cool that it's there. Beyond some of what I do, we can lend on 1 to 4 family investment properties, even on the residential side. Landmark in general does actually have a pretty cool, I call it our mom and pop investor loan. It's not aimed for somebody that owns 30 apartment buildings. This is somebody who owns, maybe 1 to 5 rental properties. Maybe they're looking to buy their first, or they just have a couple. This isn't somebody with a giant portfolio, but it's, if you want to do it in an LLC where it truly is a business, not a product that I personally offer, but it is something that Landmark offers. It's pretty cool in how we look at that. We're a little more flexible on some income things. Our rate is pretty competitive. I think that's a good one that we have out there. That is for 1 to 4 unit non-owner occupied properties. So we are seeing a lot of people right now who are trying to pick up their first rental property. I think they've realized if rents are going to keep going up, maybe now's a good time to own a rental property. So that's a kind of cool one that we have out there that I could certainly connect you with. And then, the other thing to keep in mind, people always think about purchase loan. We really do have a pretty generous home equity loan program. And the reason that can matter is we have so many people right now who are looking at the market and saying, well, yeah, I totally want to move and sell, but I'm scared to put my house on the market until I know where I'm going. I want to know that I've got that house secured before I put mine on the market. If you can't get the equity from that house yet to put down on the new one, not everybody can move forward that way. Not everybody has savings to put down the down payment. Home equity financing can be a really good way to access that money now before you actually sell. So we have a pretty strong equity product, both lines of credit and fixed home equity loans. So it's an important part to keep in mind in your toolbox if you are trying to structure that next purchase, or maybe the purchase is a vacation home or a rental property. We can tap into that equity in your primary home. Likewise, that gold arm, I can do a cash out refinance all the way up to 90 on that product. So if you're looking to buy a vacation home, but you just don't really have the down payment for it, maybe we could take advantage of that higher price on your primary home right now, pull some cash out at a decent rate, and then give you the cash as the down payment on the next one. So don't forget that refinancing a property you already own can be a valid way of, getting to that next property that you're looking to add. So those are both 90% cash out, no PMI is almost non-existent in the market. Most loans are going to cap at 80% for cash out. So that is a really great way. If you are trying to access some cash from maybe a non-traditional approach, it's a much more solid way than using credit cards or, 401k loans, things like that. So.
Awesome. I got one more question for you, Amanda, and then I want to go to Brad real quick and ask him, what his thoughts are on why real estate's a little bit different today than 08, and then we'll wrap up. So, Amanda, we talked about FHA and traditional conventional loans. How much can a seller give their buyer for an FHA loan and a traditional conventional loan in seller concessions?
So most of the time, FHA, VA, USDA, they can give up to 6% in seller concessions. So maybe that would be helping them pay for appraisals, closing costs, prepaids, things like that. Conventional, there's some guidelines depending on the terms of the conventional loan itself, it's going to be 3 to 6%. But I will tell you, one of the really cool things at Landmark is because our closing costs are lower, we very rarely run into that trouble where we're going to max out those closing costs. We don't need it. But if you have someone who wants to play with a buy down, maybe a buyer says, hey, look, I want a little bit bigger credit because I want to buy my rate down and I want to use this seller credit to pay that buy down. That's something that those larger seller credits can be really great because it can help cover those. Buy downs can actually be used to pay off PMI as well. People don't realize that, but you can buy out of your PMI or buy down your PMI rate the same way that you could buy down an actual interest rate. So those seller credits can be great for that.
Awesome. Thank you. So Brad, what's the difference between our housing bubble today and our housing bubble of 2008?
14 years. Just kidding.
Love it.
No. So a couple differences. So prior to the crash in 2008, there was a lot of different things that started happening that were, quite frankly, I think a lot of it was on the mortgage side of the house with appraisals. You could pretty much tell the appraiser what you wanted. There was conversations between loan officers and appraisers like, oh, I needed to appraise for this. I needed to appraise for that. That was part of it. The other part was, stated income. Bannon mentioned earlier, a lot of the lending, over the value of the house, like just flat out lenders saying, yeah, we'll give you 130% on, 100. So those were a lot of it. And then you had mass buildings. So I don't know that the inventory really shrank. Whereas today, probably starting in 2016, really probably starting 2017, 2018 is when you saw our inventory levels shrink. Okay. And now today's market is less about the lending practices. Amanda's covered this stuff. Like you can't buy an appraisal anymore and get whatever price. It's very regulated. There's communication restrictions, all that kind of stuff. So what we saw the last couple of years was really true economics, supply and demand. We had a lot of people that during the crash just didn't buy. They had to get through foreclosures. They had to get through bankruptcy periods, which used to be a lot longer waiting period than 2 years. What it used to be what, Amanda, like five, it was 5-7 years at some point.
Well, so 2 years is for FHA, VA, USDA. Conventional is still 4 to 7, depending on some of the terms.
So you had some people that were already homeowners that got foreclosed on, developed with bankruptcy. So they had to wait a period before they could buy a home again. So then you start having those people enter back into the market. Then you've got all the first-time home buyers that just didn't buy because lending kind of shut down a little bit for a few years. Could you do it? Probably yes, but it just, things really slowed down. So now you got all this influx of buyers and the inventory levels just couldn't sustain it. So we got ridiculously low in inventory. And that, of course, creates the demand and the prices start going up. So that's actually very healthy. When you have supply and demand issues, to me, that's a healthy market. And Amanda's right. She said earlier, eventually what happens is it's just not sustainable. And that's what we're seeing. So interest rates start to go up. That'll take some people out. Some people then kind of want to wait. Some people just started to get frustrated last year that they're having to literally get into a bidding war on every single offer. So we had clients that just said, hey, I'm just going to wait for this to calm down. I just had a client text me today, literally said, you were right. Things are calming down. Let's start looking in February. And I think that's a great thing. So I think the real estate market's very healthy. And from our side of it, I think it's very balanced now. So if I haven't contacted you yet, or you're just curious, I got several clients that kind of left the market last year. It's time to re-engage because I think it's time to start looking. And like Amanda said, I think interest rates they're going to come back down some degree. They're going to get down to, I think we get down to like a 4.5%, 5%, even 6%. It's a very, very normal and good interest rate, in my opinion. If you look at the 50-year histories of mortgage rates. So So that's the big differences right now.
Awesome. Yeah. So supply and demand, right? So thanks, Brad. Thanks, Amanda. One of the other things just kind of to touch on for our buyers and sellers out there, seller concessions are really big, but make an offer. Right now, we're dealing with a lot of, buyers that are like, it's overpriced, whatever it might be. Let's just make an offer on that property. Even if you are offering, 5 to 10% under list price. Yes, Brad has a comment. I'll let him go.
Well, I have a question actually, because we were talking inventory, and you had these stats. I don't mean to put you on the spot. Hopefully you still have them handy. When we talk about supply and demand and inventory, you actually gave the stat from a couple months ago, the amount of inventory was out there to now what's out there today and how much it's increased.
Let's just
calm down in pricing. So what?
Yeah,
do you know stats still?
I do. It was, so I compared this November compared to last November. So a year ago, there was in November, just over, and we're talking Southeast Wisconsin, Kenosha, Racine, Walworth County. There was just over 216 or 236 active for sales on the market. So single family condos, vacant land, commercial, multifamily for sales, little over 200 of those were available in November, beginning of November. Beginning of this November, over 2,300 active listings in that area. So, that is what drove prices up. The bidding wars was very low inventory. Inventory is starting to go up. We're not at where we should be. We're at about almost a 2-month supply right now, and we should be 3 to 4 month supply. But, that huge difference, and that's kind of what drove over the last year on the bidding wars and people trying to get well over ask price. So yeah, good question, Brad.
Yeah. So, and I just put it in the comments for those of you who didn't do the math. That's over 1,000% increase in inventory. Think about that. That's a big shift. So now I want to kind of answer a question that's come along with that is, are we now seeing a dip in prices? I don't really, you could call it that. Yeah. I've told clients okay, if we got $600,000 for your house in July, we might only get 570 right now. I don't think it's because the market's actually gone down. I think the market was so elevated and those bidding wars caused a little bit of craziness that I think we've just leveled off, like Amanda was talking. We're going to see that 3 to 5% appreciation range now. So I think that's where we're at.
Yeah, I agree. So, thank you, Amanda. Thank you, Brad. We're at the top of the hour, so just kind of respect everyone's time. I definitely appreciate it. Very helpful, very informative. Love doing these things because I really think giving people the knowledge and informing them what's going on in the market today is, it gives them the comfort to know that, okay, it's still a good time to buy. It's, always a good time to buy as long as if you're renting, then we talked about it the other night. If you're paying rent, you're paying 100% interest. You are not creating any equity. You're not doing anything for yourself. You're padding someone else's pocket. So it's always a good time to get into something. If you have lending questions, Amanda, would you mind throwing your information into the chat there in case we're going to share this recorded
Absolutely.
That way, if people have questions, they can reach out to you directly. I know Brad just shared our stuff in there. Yeah, don't hesitate to reach out to us. Love to help you out, answer any questions, whatever it might be. So we'll let Amanda get that in there. Awesome.
I'm on the spot. I can't type on the spot.
There we go.
There we go.
Great. Well, we appreciate everyone's time today. Thank you so much. Give us a call if you have any questions. Have a great day, everyone. Bye.
Bye, everybody.